All right, traders, I am back again with another video. And today in this video, I'm giving you a peek at our Ichimoku Masterclass. This is going to be the unit number 9, where we are talking about trading Ichimoku with support and resistance. But basically, I'm not going to just be talking about Ichimoku concepts. I'm going to be talking a lot about support and resistance concepts that apply to any market, anything that you're trading. We're going to break down some support and resistance. Then we're going to get into a little bit of Ichimoku wave analysis, because we're going to be focusing on the N wave, the S wave, the Y wave, and the P wave. And I'm going to show you how those levels or those structures are used for support and resistance. So anything that you like here today, please visit my website, www.fxatOneglance.com. And if you like what you see there, think about becoming a member. We have a membership offer, and hopefully we get to see you as one of our members. Then you'll be able to get this content all the time, every day, whenever you want it, at your will. All right, guys, so sit back, relax, buckle up. We're about to go on a nice Ichimoku journey into the clouds. All right, so here we go. We're going to get started. Today's session is going to be basically support and resistance. It's not going to be just really Ichimoku. It's going to be stuff that you can use in the markets, period. But at the end, I'm going to get really technical into some deep Ichimoku stuff. So hope you stay for the end. And afterwards, I'm not going to go through charts. So I'll probably talk to you guys after our next session. So let me get going. All right, guys, I am here getting ready to get started. But before I get started, just wanted to give you a little word of encouragement. And that again comes from Mark 1, verses 14, 15. And it says, after John was put in prison, Jesus went into Galilee proclaiming the good news of God. The time has come, he said, the kingdom of God has come near. Repent and believe the good news. So what is the good news? These first words spoken by Jesus in the book of Mark give the core of his teaching, that the long-awaited Messiah has come to begin God's personal reign here on earth. Many of the people who have heard this message since Jesus came have been oppressed, poor, struggling to make ends meet, and without hope. And if that's you today, I want you to know there is good news for you. I'm here to tell you that no matter what your condition or your struggle, Jesus' words are good news because they offer freedom, spiritual blessings, and most importantly, the promise of eternal life in a perfect world where justice and peace prevail. Our world lives in a rebellious, a rebellion against God and in misery because of this. But Scripture speaks of a day when the earth will once again be under the dominion and the blessings of heaven, where God rules uninherited, a day where all the prophecies will be fulfilled. This is the good news for both you and I and all of mankind. So all praise go to my Lord and Savior, Jesus Christ. Thank you for being patient there with me, and God bless. All right, guys, so if you're new here, if you've never been here before, because I've opened this up to everybody, I want you to know that you can visit my website, fxatOneglance.com. Anything that we talk about today, if you're interested in it, you can visit my website. And we have a membership, but we also have a bunch of courses and things that you may like. So some of the courses that we have are our high probability price action course, Ichimoku Advanced Japanese Techniques, Ichimoku Foundational course, Know Your Indicator, Trading with Fractals, webinar e-learning. The webinar e-learning is basically all the webinars we have, we just put into one big pile, and that's for you to just look at for past webinar sessions that we have. All right, so you'll be able to check out every webinar session that we have if you miss any. Then we have our e-learning 2021. So that's the webinars from this year. The previous was the webinars from last year. The Ichimoku Masterclass, which you are attending right now. This is chapter 9, I believe. And then Forex for the Beginner. And then we have 2 other courses that will be coming out shortly are the Mastering the Psychology of Trading and the Stock Market Foundational course. So if you're interested in any of that content and you're not a member right now, you can become a member. You have the opportunity to become a member. We have a 1-year membership, which is $500 a year, which gives you all of those courses, webinars like we're having today, a chat room, trade alerts, member community where you can socialize and talk to other members in our chat room, and expert walkthroughs of the content that you're getting like right now. Okay, so there's a one-time yearly fee of $500 and you get all that content, or you become a lifetime member and that's a $1,500 one-time payment and you get all that content forever, even any new courses that I create and so forth. All right, so hopefully if you enjoy that stuff or you enjoy what you see here today, you just visit my website again. Once again, it's called FX at One Glance, www.fxatOneglance, and hope to see you there. All right, so let's get started with what we really came here for. We came here to discuss trading Ichimoku with support and resistance, right? So basically, guys, just want to make sure everything is running because I want to make sure I got my screen up this time. Last time I wasn't on the screen. This time I want to be on the screen. Have you guys seeing me? You can't see me now, but you'll see me in the recording. But I just wanted to show you where we are in the course right now. So right now in the course, we're at this trading Ichimoku with support and resistance. So with that, we're going to get into all that today. Again, this is going to be more than what you really need to trade Ichimoku. It's going to be more so tailored for all markets, for anything, not just Ichimoku trading, but for just naked chart trading, if that's what you prefer to do. Okay, but then we're going to get into the multiple time frame analysis, then trading that Ichimoku with divergence, and then Heikin-Ashi candles, which will be very interesting. But then we get into the major meat of this Ichimoku right here, and some of this content you're going to get today at the end, near the end, because we're going to be talking about some of this wave theory. Okay, so hopefully you're here for that. And then at the end of this, we're going to put it all together so that you can understand all of these concepts, put them together and be able to trade it. Okay, so let's get going. Support and resistance. Support is a price level where a downtrend can be expected to pause due to a concentration of demand. At the price of an asset drops, demand for that asset increases, thereby forming a support level. So as the price drops, demand for that asset increases, and then that forms the support level. Resistance is a pure price level where an uptrend can be expected to pause due to a concentration of supply. So as the price of the security rises, supply for the asset increases, thereby forming a resistance level. So guys, if you have any questions throughout this time, just put them in that chat and I'll be able to see and I'll be able to answer your questions if you have any. All right. And Bob, again, I appreciate you for being here, man. Thank you for being here for the first time. I know it's your first time. So here you see a support level and then a resistance level. Support level where the market fell to the bottom, resistance at the top. We're not sure of support and resistance level, or actually how strong the level is, because actually the level's never been tested. We see it's support and resistance because it turned the market around. So think of the term floor representing support and the term ceiling to represent resistance. Support and resistance can be seen as a rubber ball bouncing in a room. So if you throw the ball against the floor, the support level, it will hit the floor in reverse and go up and hit the ceiling, which is your resistance level. And it'll keep doing that back and forth. And that's what you would consider a range. So the market, you'll see the ball bounce up and down, up and down, up and down, hitting the floor, the wall, the floor, the ceiling, the floor, the ceiling. That's the same thing with the price in the market when it hits the support and resistance levels. So momentum and volume from either bulls or bears is needed to break through the support and resistance levels. Right? So here you see resistance, here you see support. At support is a level where you should be buying the market. And if you buy the market, you could see what could happen. So a lot of times people at support levels try to buy the breakthrough, the breakdown, or the breakout. And a lot of times they get caught in traps, bear traps or bull traps. So at resistance is the level where you should be selling the market. So basic support and resistance requires you to buy the market at support, sell the market at resistance. And if you follow those things, you see where you can have some good opportunities in the market. And if you did the same thing here, rather than try to catch the breakout, you probably make some profit. And here we see basically if you try to buy resistance, this is what you're looking at. Traders trying to buy resistance. All right. And when they try to buy resistance because they see a nice big candle like this, they get super happy, start buying that market. And then the next thing you know, boom, the market drops to the downside. They were caught in a bull trap. So basically a bull trap is a false breakout above the resistance level, as you saw, which happened right here. All right. As buyers are convinced that the market is going higher. These buyers at the resistance level and above, and then the price drops. Boom. The drop traps these buyers, and it is called a bull trap because they were caught in a market that they thought was going to be a bull market going long, and instead it dropped. That's why it's best to always trade support and resistance in such. Now we're going to get to a point where we're going to be talking about some price patterns a little later, and we're not going to be exactly doing that. We are going to be looking for breakout trades. But to me, in a range, a flat ranging market, I like to trade the support and resistance levels until the market proves to me. Because even then, you still can keep continuing to trade support and resistance. Because this level now becomes support instead of resistance, and you can trade it long at that point. All right. This is a perfect example of a bear trap. The market reaches the support level and sellers see the price drop below the level. Sellers are happy here. They are, going crazy. We got a good trade going on. We're going to be good to go. And then what happens? Boom. Caught in a bear trap. All right. And it's hard to get out of that. Okay. So where do you get out? When do you get out? Bet you half of these or more are still holding on at this point. And then when they do that, that's what happens to you. So that's why it's best to trade support and resistance where you buy support, sell resistance. That's not a good feeling if you got trapped in there. But it's a good feeling if you were going long based on support. So a support level will eventually become a resistance level when price closes below the support level. And the resistance level will eventually become a support level when prices close above the resistance level. Let's talk about that. Here you see it. Fractal high, fractal low, fractal high, fractal low. This lets us know what direction the market is in. So then when we see this fractal high, each fractal high is basically a resistance level in a bull market. So this fractal high is a resistance level. This fractal low is a support level. All right. This fractal low is a support level. So you have fractal high, fractal low, fractal high, fractal low. So basically the market's making higher fractal highs and higher fractal lows. Lets me know we're in a bull market, and then this would be a resistance point. Then you can see what happens. The market, once it breaks that fractal high, this level is now support. All right. So now you're still, if you didn't buy the breakout, you can buy the support level. So you're still following the concepts of support and resistance by buying the support level now as the market retraces back to that level. But impatient traders can't do that. They don't have the concept to be able to wait for the market to get to a level where they're able to trade. Okay. So therefore they just take trades at any point, any time, any cause, any reason, no rhyme or reason. So that's why I always trade at a level. So I'm always telling guys we need a level, a signal, and a trigger to trade the market. So technical analysts use support and resistance levels to analyze and identify price levels where the probabilities exist for either a pause in the market, a reversal, or a continuation. This is why it is best to trade at levels. I always tell you level, signal, trigger. We want that level, that signal, and that trigger. If we don't have those three things, we really don't want to be getting into a trade. Market psychology plays a role in support and resistance levels as traders and investors remember past levels and anticipate market moves at these past levels. Once the support and resistance level or zone has been identified, it provides valuable trading opportunities via entries, exits, and stop loss levels. When the support and resistance levels are broken, the market psychology changes and new levels of support and resistance are established. The market is just minds of millions of traders. And us millions of traders, when we're all put together, we all see different levels. And that's where you see these things happening. So we want to talk about these four things here. Major support and resistance. These are areas or levels that the market has previously stalled or corrected at, and then it's been tested at least once and fails. Minor support and resistance is an area or level that the market has previously stalled or corrected at and then violated on the first attempt, okay? So the minor support and resistance level, when it's tested for that first time, it's really broken through. So really, like you'll see we'll look at these on the chart, but basically you're going to see the market make a high and then correct itself and then break right through that high instead of using that high as like a double top or whatever. So proactive support and resistance, these levels are levels that remain the same and never change, such as horizontal support and resistance levels, pivot points, Fibonacci retracement levels, and trend lines. And then reactive support and resistance levels, these are levels that are always changing and recalculating with the price action. Those levels include, but they're not limited to, moving averages, Bollinger Bands, Donsian Channels, Kijinsen, Tenkan-sen, Senkou Span, A and B, Ichimoku levels. Here you see a minor support level. Why? This is a minor support level because this level has never been tested. Now it's a major support level because now it's been tested and we're sure of what the market is able to do here. I have some of my slides stalling on me. Let's go back. All right, so we want to move to next is our inside bar at support. So basically, let's go back again. This was the main level here, then it got tested to make it a major support level. When it first came down, we knew it was a support level because it retraced the market, or it reversed the market basically. But then when the market came back to that level, we realized that it held and it was a support level, a major support level. So next time the market gets to that level, again, we'll be looking for that level to trade at. Now, the first time it comes down here and you see the level, you're not exactly sure because it never has been tested before and you're not sure if it's going to hold. So you wait to see if it's going to hold, and here we did. Now when it comes back again, we feel a little more confident because we know this level's major now. Okay? So now I want to talk about inside bars at support, okay? An inside bar at support. An inside bar is a 2-bar or more candlestick pattern where the first bar or candlestick consolidation sits inside a rest area, or it sits inside the asset and doesn't break outside of one candle for a few days. All right, it could be 1 day, 2 days, or whatever. But here you see it was quite a few days. So what I like to do is mark these levels, and I don't mark the high and the low. I mark the bodies because to me, if the market can't break outside of a body of one candle, all right, then that's relevant to me. It hasn't traded outside of that body. So therefore, what I like to do is trade these consolidation levels at support. So basically when the market breaks, and you can see it did the same thing at this level right here, and basically the same thing here. So the market went up, came back, went up, broke this level, and sat here for 2 days inside this one candle and consolidated, and then it broke above. But then we catch this one here where we're sitting at a support level, which was resistance, which now is support. So we have an inside bar at support. That's major. And basically we have consolidation at support. And when you see that, we wait for the close above. And what I do is I actually never trade the close above. I just put an entry at the highest wick right here. So I'll show you. So this is my level. It's minor support level. So notice how just the bodies are marked, but I got my stop loss level here and my entry level at the high. So my stop loss level is at basically the previous level that was violated. Now this level was violated and I want to be a little bit below that level. And then I want my entry at the high wick, a little bit above that wick. So now I just let the market trigger me in. And then you can see what happens. We're in a good trade. Then you see the market, what does it do again? It trades inside one candle right here. This inside trading is super big. All right, so here's an actual bear consolidation trade that I was currently in. All right, this is a bear consolidation because the trend was bearish and we're breaking bear fractals. Here you can see the high wick of the consolidation rejected the upper bull fractal. This level was used for a stop loss and the low wick was used for entry with the sell stop. I got triggered into the trade and you can see I made some profit at that point. And this market is still going to the downside right now. All right. So again, you could see previously we had a bull consolidation level at support. This time we have a bearish consolidation level at support because we're at resistance, because we're at the resistance of this low, this fractal. And I actually could make this into a zone and then trade off of that bottom. But what I got was this zone here where we were trading inside one candle. And I actually broke it down even deeper because I traded inside this one candle right here. And then we had the low here and we were triggered into the trade and then we made good profit. Okay. So that was an actual trade that I took at that point. Now we want to talk about something really big because this is going to be talking major about as I get deeper into this session here, you'll see what I'm talking about. But we discussed the fractals last week, so I'm not going to go into major detail about fractals. Fractals are support and resistance levels that are found at reversal points in the market. They are extremely useful in a trending market, and they'll discuss them and how the effects of them take place when you're trading, right? So I'm not going to discuss those in detail right now, but on the chart you see the candlesticks, right? And you can see where these green arrow is and these red arrows. These are the fractals on the chart. These are basically swing highs, swing lows, and they help me a lot, and they help you a lot, and they can help you where you're trading, whether you're trading Ichimoku or you're just trading a naked chart like this right here. You don't need anything on your chart to trade what I'm showing you right here because these are support and resistance levels. This is support, this is resistance. Every green one is resistance, but some of them aren't tested. All right, but when we see this, and we're going to get deeper into detail in a little bit later about this because this formation is really an S wave, and I'm going to discuss it a little more, and it's part of Ichimoku. But what happens is you break this fractal high, so this bull fractal you violate, and then you pull back to that level. This is my number one trade that I always trade. I'll trade this more than anything else. Anything, not Ichimoku. Ichimoku is not my number one trade. This is my number one trade. This actually comes from Ichimoku though, because it's an S-wave trade basically, because you have an S-wave formation. I'm going to talk about it in detail a little bit later and show you how I trade it. All right. But these fractals are super important because they represent support and resistance levels, and you can see that. And they also represent the direction of the trend, which is super important. It helps you to understand that. So a lot of times as the market's moving higher, it breaks these higher bull fractals and it fails to break the lower bear fractals. In that case, we can use these as stop loss levels. And it also lets me know that the bullish trend is continuing. Once we start to break bear fractals, then I start to realize that the trend change may be taking place. That's a very important concept. All right. So that's why these support and resistance levels of fractal levels are very important for you. And then I like to make these into zones. All right, let me go back. So you can see where I have this. This is going to be the exact same thing. We go here and we have the exact same thing taking place. All right. So first we notice at point A, the market has created a low bear fractal that was not broken lower. So to the left of that low bear fractal, the market was violating the low bear fractals and not the upper bull fractals. So we were violating these bear fractals, not the upper bull fractals. That let us know that the trend was bearish. All right. All right. So that definitely let us know we were at a downtrend. And then at point A, that downtrend ended. And at point B, the market broke its first bull fractal. So we did break a bull fractal here, but in this case, we were breaking bull fractals and bear fractals. And when we see that, we kind of know that we're ranging. All right. But then we broke this bull fractal at point B, and we were sure of the trend direction at that point. Okay. So this is a real sign of a trend change when we broke that bull fractal at point B. Moving farther up, we see the market created a bull fractal that was violated with the last green candle, that very last green candle. This candle was the last one that violated this fractal right here. All right. So what I did, that fractal has a wick on it, so we created a fractal zone. As you can see, I made a fractal zone. At this point, I already know where I want to enter the market, at that fractal zone when price returns. But here's what happens. I just mentioned it before. Impatient traders think they have to chase the market and jump on here or even higher. Other traders who know the strategy do not see the price come back as soon as they want, and then they lose interest in the trade and then they miss out. And then still other traders don't even understand that they're trading into a support and resistance level, and then they have issues here also. So since you know where you want to take the trade, you should place an alert on your chart to let you know when price gets to this level. So a lot of traders, we know we want to trade this level at this point today. If we were here today, I know this is where I want to trade. This is a support level. It was resistance, support. I know I want to trade this level. What I need to do is put a price alert a little bit above that level. When the market gets there, it'll alert me. I use Think or Swim, and then that way it'll send me an email. Or a text message or whatever, and let me know that price has reached my level. And at that point, I'll come here and get very interested in the trade. All right, so here we see, this is where we were. This is where impatient traders are jumping on, but some of this is profitable. All right, but then this is where I get interested into the trade. All right, I wasn't really interested here or anywhere in here, but then I got interested here. But in order for me to catch that, I need an alert to let me know when the market gets to that point. All right. So everyone hear me pretty good? Someone said they don't have sound or something. Everybody hear me good? Let me know if you can hear me. All right, good. Thank you. Appreciate that. If you don't have sound, you can't hear me, so I can't tell you that. You need to probably log out and log back in, but that's what I would tell you if you could hear me. Okay, but again, we could see price returns to our zone. There are many ways to enter the market at this point, such as like candlestick patterns are going down to a lower time frame and entering the, like on the first bull fractal. All right, so we could go to a lower time frame and enter on the first bull fractal break. And I would show you that on a live chart, how to do that, because basically what we're doing basically is going to the, once we get to this level, we go to the lower time frame because we're going to what we call walk this zone. All right. So how we walk the zone basically is when the market touches this zone, this is where we want to enter the market. So we wait to see what the market's going to do. If it drops a little lower, we always want to be above the market to enter the market long. So we'll put an entry above that zone slightly. The market drops lower to the middle of the zone, we'll move our entry right to the top of the zone. If the market goes all the way down where it was now, we'll put our entry at the middle of this zone, just like it is, in the middle. All right, so we reduced our risk because now our stop loss is down here at this bull fractal. At this bear fractal. And a lot of times traders will put their stop loss right here under this zone. It's a good way to get stopped out because the market likes to come down and reject this level again and then go to the upside, all right? And then you can see what happens. Now, if I stayed on the daily time frame, I just, like I said, would have entered basically with the zone walk, and I would have had an entry at the midpoint here. The market went higher, came back again, then moved higher. Again, remember what I just said about putting your stop loss right at the zone. If you put your stop loss here, you were probably very scared right here. All right, because the market came pretty close to coming back to stopping you out. And had you didn't mark it right, you probably could have got stopped out. Okay? Then you'd have been pissed off and said that the strategy doesn't work, blah, blah, blah. Once again, you could see another fractal zone. So the same thing is going to apply in the bear market. I just showed you a bull market. This is a bear market. So again, at point A, price has not broken the bull fractal highs, but instead breaks the bear fractals. All right, so it hasn't broken this last bull fractal high because we were breaking these bull fractals. But then we started to break these bear fractals and not the bull fractals. And look, we stopped breaking those bull fractals. Now we did here, but we had a little correction and then came back again. This is some points where I get kind of confused, but throughout this point, I kind of know what's happening. But sometime here it gets a little bit confusing, but that's when you have to use your wave analysis to make sure you're in line with the market structure. All right, but then you can see what happens. The market breaks this fractal zone. And like I said, I'm going to be waiting now. Some traders are jumping in here. I'm going to be waiting for the market to come back here. Will the market come back there? Yes, eventually it does come back there. At this point, this is where I'm going to be entering the market. All right. Now, sometimes these trades are hard to catch. All right. Because you can see the market return to the zone. But this time it didn't walk up into the zone. It just broke below the zone. So this is why you have to be able to catch the market at this point. That's why you have to be able to do this. You're not going to catch these trades. What's going to happen here is you're going to catch the trade down here, which moves you farther from the zone, which gives you more risk. The farther away you take your trade from the zone, the higher the more risk you have, and not always the higher probability, because sometimes you may be at a point where the market may correct itself like it did previously on the last slide. Let me show you what I'm talking about. Like this, we entered here already, and then the market came back again. All right, so that's what I'm talking about basically. But so the same thing is here. You want to be able to get the best entry you can. You don't want to be too far away. So the best thing is, now I'm looking to put my entry here, but what I would do now is go to the lower time frame, like the 4 hour or the hourly, and then I'm going to look for the fractal break when the market breaks this level. Because what's happening now, on any time frame that you go to, the market's probably breaking bull fractals. All right, and therefore, once it gets to this zone, we should see it break bear fractals, and then we can get into a short trade. All right, but we want to do that on a lower time frame. Like I'm trading the daily, maybe I'll go to the 4 hour to hourly and take that trade on the break of the bear fractal. All right. So price returns to the zone. It's hard to catch this trade. Like I said, you have to go to the lower time frame in order to catch this because it's not as clean as the previous one I showed you. And then you can see what happens. Again, it never went up into that zone. So if you were looking to catch it inside the zone, you don't catch the trade and it goes on you and you're mad. All right. Support and resistance can be seen as supply and demand zones because at these levels, there's an abundance of buy or sell orders. In this case, there is a strong buying interest because by a large volume of, it's caused by a large volume of buy orders, basically. So you could see right here where these X's are. If there were an equal amount of buy and sell orders at this level, then the price would not move away from the level. It would just basically range in this level like it did here. So it was kind of equal here. But eventually it seemed like more buyers came into the market at this point. All right. This level is a major resistance level because it has been tested and proven. And you can see all the tests and it's proven. All right. This is caused by an abundance of sell orders. All right. It's a big sell zone, supply zone, and it's considered resistance. So how do you find, or how do you draw support and resistance levels? First thing you got to do is start with a bird's eye view of the daily time frame, even a weekly time frame or a monthly time frame. All right, you have to have a bird's eye view of the chart. This chart is showing price action over 5 years from basically 2015. The daily time frame is used because support and resistance levels, the higher time frames, are stronger and have a higher probability of being valid. Therefore, you have the possibility of price turning at these levels. You could even use weekly and monthly charts, just like I stated, to find more significant levels and then trade those on the lower time frame. But one thing you can't do is catch the market like this and draw support and resistance levels. Let me show you. This chart right here is this part of the market right here. Just this. That's what that is. This part of the market right there. And you're going to draw support and resistance levels just from that? Okay. So what you need to do basically is expand that chart. So first you want to find your extreme high levels that have been tested at least once, as shown here. And then now you can draw these levels and draw a line on the bodies. The level on the left has a long wick protruding through the body. So what do I do there? See the long wick protruding through that body? I like to make that into a zone, basically. So I put a level at the body and the high. So now that's a zone for me. And so now I know this is a resistance zone. And now you can see where the zone got tested, and now it's a strong resistance zone. I know it's a double top, and boom, the market drops to the downside. And then I want to mark my bottoms, my lows. So mark the lows on the chart within that area that have been proven and tested. So mark the levels that have been proven and tested. You can see these two good levels were proven and tested. So now I have a high level and a low level where I can now mark in between these levels, okay, to find support and resistance. Then the next thing you want to do, you can also mark this as an unproven and untested low with a different color to identify it. So basically it wasn't tested before, but you can mark it as a with a different color so you know that it wasn't a tested level. Now also you could see the zone here, but I wouldn't consider this a tradable zone because it's too big. What I mean by too big is it's the difference between this upper level and this lower level is too far apart, which could be like a couple hundred pips, all right, or a couple hundred units or whatever, and that would be too big for you to use to be able to draw to trade support and resistance levels. Then the next thing, you want to mark lines that have been proven to be both support and resistance levels. So you could see this was both a support, resistance, support, resistance. These are going to be strong levels on your chart. This is what a final chart might look like. And I wouldn't consider this overkill because these lines are probably averages to be about 200 pips apart, and you're looking at a daily chart of a bird's eye view of a daily chart. Let me show you what it would look like more if we zoomed in. So now you can see it zoomed in, and this area is about 6 or 7 months of price action, and you can see clearly these support and resistance levels and nice movements between these levels. And there's probably other levels that you could even put on here between this bigger level. All right, but these are nice clean levels that you could look at, support and resistance levels, okay? Now what I would consider is this. This would be considered cluttered and overkill, and you don't need this to trade support and resistance level. This would be more confusing than anything, all right? So you don't want a chart that looks like that. So horizontal support and resistance levels. This is a horizontal proactive support and resistance level. This level never changes unless you change it. But price is not changing this level. Well, in a way, price does change this level, but it doesn't make this line move. You can only move that line. So it's a horizontal proactive support and resistance level. This is a trend line. It's a proactive support and resistance level. It cannot be moved only by you. Price does not move this level. Fibonacci retracement levels are proactive support and resistance levels. Once you set them there, price doesn't move them. All right, price might acknowledge them, but price doesn't move them. Now, Bollinger Bands would be a reactive support and resistance level, basically because These upper and lower bands are moving with the price. They're changing with price, all right? So they change with price. Therefore, they are reactive support and resistance levels. The Donsian Channel is a reactive support and resistance level. These upper levels, again, move and change with the price. And then a moving average is a reactive support and resistance level. These moving averages move based off the price. They could be based off of the high, the open, the close, the low, however you have your moving average set, but they move based off of the price. All right. So they are reactive support and resistance levels. Very good levels to trade. So Ichimoku has levels of support and resistance, which are basically your first level of support and resistance would be your Tenkan-sen. Second would be your Kijun-sen. Third would be your span A. And fourth would be your span B. Let me show you. Bullish market. Markets above this level are even at this level. Number 1, Tenkan-sen. Number 2, Kijun-sen. Span A at the top of the cloud, span B at the bottom of the cloud. Those are support and resistance levels, proactive. First level of support and resistance is your Tenkan-sen. And you can see if you buy at this support level, you're above the cloud, you got a crossover that's bullish, boom, the market goes your way. Again, if you buy at the Kijun-sen, a support and resistance level, boom, the market goes your way. You could see you're in an uptrend also. Now, I'm not saying these things work all the time, but these are the trades that I'll look for. All right, this is the kind of trade that I'm going to be looking for. And then you have your upper span A. All right, your upper cloud, the top part of your cloud, which is a support level here, and you can see what happens. It restricts the market from moving lower, and then boom. So we've had 1, 2, 3. This here now, this price dropped from the first level, second level, all the way to the third level of support. We're still bullish because we haven't broken through the last level of support. Now the market is at the last and final level of support. We're still bullish pretty much, but we're starting to see bearish signs in the market. We've reached the last level of support, span B. All right, crossover. You got a Kumo twist, TK crossover. Chiku span is below the price. All right, Chiku span is 26 days away from price backwards, and here it would be in this area. It's below the price. Okay. And you can see what happens. Market moves higher. Comes back to that support and resistance level. All right, and now this becomes basically resistance. And then the market drops. So the market broke all these 4 levels of support and resistance. These are big signs for you. Then you see the crossovers developing, the Kumo twist develop. The market made it all the way to the 4th level of support and resistance. A lot of times in a trend, that's not going to happen. It's not going to get that far if it's a strong trend. But this trend became weak. So previously, if you look backwards, this market did not break through these levels, did not reach these levels, and therefore we knew we had a strong trend and we were able to continue trading in that direction. Now, the levels of resistance are the same going upwards, okay? So basically you have the exact same thing. Tenkan-sen, Kijun-sen, span A, span B. Always going to be span A and then span B, the last level. Here you can see the bounce off of Tenkan-sen, first level of support and resistance. Good area to get a trade. All right, in a strong trending market, the market's not going to violate Tenkan-sen often. All right, so therefore you see the first time we broke below Tenkan-sen, we didn't break back above it anytime in this area, which is a good trading opportunity for you guys for trading support and resistance levels. Then you could see where we bounced off of Kijun-sen. Wouldn't these be super trades for you? The market's bearish. We're below the cloud. We got Kumo twist that's bearish. TK crossover is bearish. Chiku span is below price. And the market is bouncing off of the Kijun-sen level in steps. Wouldn't those be good trades for you? So the market also considers this a resistance band. This is just a big area of resistance. All right. So a lot of traders see this over here and say this is an area where price is going to be. This lets you know where price is going to be in the future. That is not true. This is not telling you anything about where price is going to be in the future. If you believe that and somebody told you that, they are totally wrong. This does not tell you where price is going to be in the future. If that was the case, then price should always be on this cloud all the time, because this is the future and that's where price should be, always in the future, right? That's not the case. This is a support and resistance level in the future. All right, it's not where prices are going to be in the future. It's where prices could be, and if they are at that level, it's going to be support and resistance. All right, future support and resistance levels, not where price will be. If it was the case, why wasn't price here before? All right, because it's not the case. It's just future support and resistance levels. So basically you could see how strong these support and resistance levels are and for you to be able to take trades. So every time you come back to this cloud, able to catch a trade. All right. Every time you come back to Tenkan-sen or Kijun-sen, you're able to catch a trade. So in a bearish market, we can look to trade short off any of the 4 Ichimoku resistance levels seen here. In this case, the lower Kumo, which would be the Senko span A, acts as resistance, and entering a short trade with stop loss above the Kumo would be the option. Near the end of the trend, we see price bouncing on Kijun-sen. So all the way up here it was bouncing on your span A. But then we started to get on to the Kijun-sen level. All right, and that's where you can take trades at that point also. So we're going to talk a little bit more about the bear fractal bounce. So now you see where we have a fractal. And now you see, and I'm going to get even a little bit deeper on this in a little bit after we get past these few couple slides here. But the thing that we're looking at now is a bear fractal resistance point, all right, where you broke that level here and now you pulled back to this level. And what I'm talking about is basically I got a TK crossover that's bearish. My cloud is bearish. Chiku spans below price and the future is dark. All right, it's a rainy day. So we know that we could be looking for short opportunities off of these resistance points now. We're not worried about these upper points, these upper fractals. We're only worried about these lower fractals now, because these lower fractals are going to be resistance points for us. They're not going to be support points for us, because we want the market to break these levels, these lower levels. That lets us know that we're in a bearish trend. Ichimoku's telling us we're bearish. Price is showing us the same thing by breaking these fractal lows and then coming back to those levels and then bouncing off of them back to the downside. All right. And here you can see what happened. Same thing that we talk about. Now, we're going to get a little bit deeper with some price patterns, and we're going to talk about a little bit of Ichimoku wave analysis, just slightly. Ichimoku support and resistance price patterns. Ichimoku also has recognizable chart patterns created by price. The study of Ichimoku wave analysis offers 3 very distinguished price patterns that are seen as support and resistance levels. Those patterns are the P wave, the Y wave, and the S wave. I will discuss these patterns further in unit number 13, which is going to be the Ichimoku wave analysis, but I'm also going to discuss them right here and show you how you trade these. And the reason I am including these as trading support and resistance levels is because these form support and resistance levels, consolidation levels that you can trade, and I'm going to show you how to trade them and even trade the breakout of these levels. So let's move to it. So basically this is what a P wave looks like. The P wave is a wave in which the width of the top and bottom gradually decrease and the wave continues many times, resulting in a state of conflict, okay? And that's what you have here. So again, a P wave in a bull market is also known as a bullish pennant pattern that indicates the impending continuation of a strong upward price move. All right, so you can see the P wave here. I have it outlined. They're formed when a market makes an extensive move higher, then pauses and consolidates between converging support and resistance levels. All right, this is a continuation pattern, and traders should be looking for the move to resume higher after price takes a rest. So to identify a P wave, first observe a pronounced upward movement known as the pole, all right, which would be basically in this point, it would be right here. You could see this pole move, all right. And then next, the price consolidation that forms the symmetrical triangle pattern, all right. And these can be traded. Now, more so, with Ichimoku, we're looking at this and seeing this bullish P wave, and we're thinking we can catch a trade here, right? Let me move on and show you. Here we see the breakout of the formation. This would constitute a long entry. You can find your targets basically by setting your 1-to-1 ratio. So your target can be achieved with Ichimoku price observation theory, which we'll learn later, and the measured move as seen here. This is a measured move where we're shooting for this level right here. All right. And your stop loss can be placed in the middle of the zone or below the bear fractal. This is your bear fractal. Remember how we said the market doesn't really like to come back to those levels in a bull market if it's strong? So therefore, why wouldn't we use it? Because what we're really looking for, this is a continuation pattern, and this is consolidation. The market took a run. So what you're seeing is a guy running a sprint. He runs one lap, he's tired, he takes a break. But he said he's going to run 4 or 5 of these laps. After one lap, he took a break right here. He's going to start the next lap right here. So if he's going to start the next lap, he shouldn't be walking backwards. If he's walking backwards, he'll come here. We don't expect him to walk backwards. We expect him to move higher. And that's what we expect the market to do, move higher. And therefore, we're going to get into a nice long trade because now we're looking for momentum, really. We're looking for the market to break this level and move off of momentum because now we're building up. We've built up momentum through this point. We got our rest in, and now we could take off again. If we can't take off and we're still tired, then we really don't want to see the market come below this level. Because if it does, we know what we talked about and what we're looking for is totally done. Really, to me, if it even comes back to the midpoint or a little bit lower than these levels here, you don't have the momentum more than likely to move higher. And then you could see the measured move target was achieved. This is the 1-to-1 ratio right here. All right. It took it from this leg to this leg, from this bottom to this top. So what it is A, B equals C, D in length. All right. And that's all it is. And we made it to the 1-to-1 measured move level right here. And a little bit more. And that's how I find all my targets. 1-to-1 measured move along with your observation theory, Ichimoku observation theory, and we're going to learn that later. But that's how I find all of my targets, every single target. And then the other targets, really, I look left and find support and resistance levels and use those. So here's a bigger P wave, and this is a bearish P wave as it occurs in a downtrend. This formation is also known as a bearish pennant that indicates the impending continuation of a downward price move. They're essentially the opposite to bull pennants. All right. Instead of consolidating after a move up, the market pauses on a significant move down. When traders spot these bearish P waves, it's a sign that the downward move is going to continue once the market breaks below its support line. Now, again, you can trade these support and resistance levels, but you're not sure of this level. And by the time you get a chance to trade it, a lot of times what happens is it breaks out because you don't realize this is basically probably till here. So then maybe you catch a trade down here that moves up here, and then you catch a little bit here. But eventually what you're looking for is the breakdown because we were bearish. These are continuation patterns most of the time. Now, I do see P waves on the bottom reversing the market instead of continuing. And I do see P waves on the top reversing the market instead of continuing. So don't take it as gold, but a lot of times they're basically continuation moves. Now, this is a big pennant. I showed you previously was a smaller pennant, okay? But still, it's the same thing. And it's not a pennant, it's a P wave. Regular traders would know it as a pennant, though. All right, so here price breaks out of the P wave, and this is our entry right here. Boom. And we could put our stop loss in the middle. You can put it at the back here, all right? Or you could put it at the bear fractal back here. Remember what we talked about, the market breaking these bear fractals, our bull fractals in a trend. And then what we're shooting for, what? The 1-to-1 ratio. So the 1-to-1 ratio would be way down here. That's a measured move basically. All right, and I got it 1, 2, 3, shooting for this level. This is the highest retrace back. This is the high where we start from. This is the lowest it went, and this is the highest from the retrace. All right, so we look for the breakout. Do we get a good trade? Probably not, right? Well, sorry, we did. We got the 1-to-1 level and some. So at this point, we've made the 1-to-1 leg right here and some. Let's now talk about the Y wave. It's the totally opposite of the P wave. So the Y wave formation is a rarely seen formation. You don't see it all the time. You don't see these a lot. A Y wave at the top is also known as a broadening top by conventional chart patterns, and it's seen as the top of an uptrend. It is classified as a bearish reversal pattern, usually leading to a downside breakout. The width of the support and resistance levels becomes increasingly wider as price creates higher highs and lower lows. The Y wave formation has at least 2 minor lows at support and 2 minor highs at resistance. The average of these patterns is between 1 to 2 months long, and this pattern here is about a month and a half long. All right. Rarely do I see these patterns, these Y waves. All right. Or else I'm not good at spotting them, but I don't see them often. All right. So the break of the Y wave of the lower support level, entry could be taken at that point. After the 2 minor touches at the support level, you need those touches to ensure that what you have is that Y wave or P wave or whatever chart pattern you're trading. So we're trading momentum. So we really do not want to see that price retrace back into the middle here even really. All right, because then we've lost a lot of the momentum that we're looking for the market to take us to the downside or the upside, depending on which direction we're looking for the market to go. In this case, we're looking for the market to move to the downside, all right? And then you could see, boom. Because this is a top pattern, and it's a reversal pattern. So what happens is at the top, you get this Y wave, and we're expecting the market to drop. Now, you almost came up to a double top. Near these tops, you would look for this Y wave, or near these bottoms, you would look for this Y wave, all right? And look for the market to drop at the top. And at this point it did drop, and then it broke out of that level and you were able to get your trade. Now again, we want to be on momentum, and that's why we put that stop loss in the middle. We didn't get back to that point, but it looked like we lost some momentum and then got it back. All right, you don't need that to come all the way back here to tell you you lost that trade or that trade's no good. All right. This is a Y wave at the bottom, and it's also known as a broadening bottom by conventional chart patterns, and it's seen at the bottom of the downtrend. It is classified as a bullish reversal pattern, usually leading to upward breakouts, okay? The width of the support and resistance levels become increasingly wider as price creates higher highs and lower lows. The Y wave formation is a 5-point reversal pattern, as it has 2 minor lows at support and 3 minor highs at resistance, as seen here on this chart. 2 minor lows, 2 minor highs. All right. The average width is about 1 to 2 months long, just like I stated previously. And this one is basically about a month in width. Now, we're trading this with a stock, so it's going to have some differences here. This is one of the differences. This big gap breakout to the upside. Very nice thing, which you want to see here. So here we see the price formed a breakaway gap, which is something that you can rest your hat on sometimes. So the breakaway gap created an entry for a long position. The breakaway gap forms at the completion of the formation. Breakaway gaps usually develop when price moves out of reversal or consolidation formations. The gap above the resistance level emphasizes that the fact of the breakout is a true, genuine breakout. All right, you broke out of this level, you gapped right out of it. All right, and then the market even moved higher. And you can see the market moved well past our one-to-one resistance level. All right, it moved past the one-to-one level. So trading this formation, you could still, like basically it's going to be different. Trading this with stocks and with forex is going to be different based on the one fact that you can gap up with stocks. Most of the time you're not going to see gaps in forex, maybe during from Monday to Friday. I mean, from Friday to the market open again, but usually you don't see gaps. All right, so you see some gaps here and there, but this is what you see in a stock. So that's a little different. You see that big breakaway gap, and that's a good trading opportunity for you. All right. So your targets are going to be found just like I stated previously. Now, this is a big N wave. So this was an N wave to the downside. See that wave? Let me draw it out for you. Let me draw it for you so I can make sure you see what I see. This was an N wave to the downside, right? That's an N wave to the downside. And that's how we use to find our observation theory. But what happened here was the market consolidated. So now it reversed here, and we had the N wave to the downside here, then here. All right, so we failed to break this low pretty much, which let us know we stopped making this downward N wave. All right, so that downward N wave stopped, and what happened was the market formed this wave. See that? Through this consolidation, you still want to see the price pattern of the N wave, and then it dropped back here to this low, and then it went gapped up. This is your N wave, your new bullish N wave off of the bearish N wave over here. All right, so now you kind of know which way the market is going based off of just even seeing this V wave. This is a V wave right here. If you see that, you kind of know which way the market may go, but you're not always going to know. But again, let me show you here. We had a V wave here, right? So we kind of might think the market's going to go higher because it needs to break that wave, right? That leg right there. We don't think it's going to break the beginning, but it's going to break the 2 level, the 1, the 2, the 3, and then the 4. We think it's going to break that 2 level, and that's what we're always looking for, to break that 2 level. So let me clear that and show you that now you have your V wave. Once I have my V wave and then I look for my entry, I can now start to measure for my number one, my price observation levels, which would be like this level right here would be my N level. And then I'm not sure exactly where my other levels would be. I'd have to measure, but you would have your E. Let's say this was your V, you have your N, and then you would have an NT level. This is price observation theory levels. Now, these aren't the exact levels. This is the exact N level, the exact level. And this is the exact E level. All right. This is a 200 move. This is a 100 move. 100%, 200%. This is the exact level that it would be for a 1 to 1 and a 1 to 2, which is your N and your E. Now, your NT and your V, they're not always going to be the same. So they're going to be the same, but they're not going to be calculated in a way that I can use the Fibonacci extension tool to find them. All right, so I have to mark these by hand. But those would be my natural targets with Ichimoku observation theory. I'd be shooting for those targets. All right, and then if this was a V level, that would be my target that I hit. So observation theory, I would have my NT level that I need the market to get through, and we gapped right through that level. Then I'd have my N level that I'm looking for. Now I might start thinking we're going to fail here because I got a little hangman here. All right, but price never even came near the low, and it kept moving higher. So therefore, we could shoot for the V level in price observation. When we got to the V level, we had indecision at this point. Now, what I would do I'm always moving my stop loss anyway, and I'm also doing 1-to-1 risk, 1 to 2, 1 to 3. Well, anyway, when you move up, if you get that point, you want to put your stop loss at that point now. And here, I would have put my stop loss here when we got to the N level. When we get to the V level, I want to put my stop loss here. because now I got indecision and I'm believing the market may fail. And then if it does, I'm stopped out, but I made all my profit from this level up. Okay. Any questions? Any questions, may I ask? If you have any, let me know now, because I'm able to answer anything for you at this point. But again, our price observation theory is going to be discussed on unit 15. So we got a little bit more to go before we get to that. And then you'll be able to understand how to find these levels really well. Next is my favorite. This is what I trade all the time. This is the trade that I trade all the time. All right. It's called a fractal bounce with Ichimoku, but in reality, if I'm trading with Ichimoku, it's called an S wave. This is an S wave. All right. This is the main focus for me when I'm trading, to see this S wave. All right. I want to trade this with any chart, no matter what I'm trading. If I'm trading Ichimoku, if I'm trading Mutu Ichi, no matter what, I always want to be looking for this S wave formation. All right. And it's a strong pattern. All right. And it also forms, sometimes you can see inside of this pattern, all right, an ascending triangle pattern. Let me show you. I know you can see it, but let me make sure that you can see it. We have this high, and then this low, and this low. All right, coming off of the leg, we form this resistance point, and this is how you can start to see it a little bit. I see it different than this. And then it has this trend line at the bottom and a flat line at the top. That's an ascending triangle pattern that we break out and then pull back to the top. I see this a little bit different. I'm going to explain it to you in a little bit here. I don't really look at it in this form. All right. What I look at, I find this form first. And I'm going to talk about it in a second here. Remove that stuff. Basically, we should be analyzing the market with each wave discussed, right? So basically, we should look for the market, that N wave, that I wave, V wave, and then consolidation waves, which would be the Y wave, P wave, S wave. All right. Those are the consolidation waves, basically. All right. If you do that, then you can better determine what the market is doing or might do. All right. So the S wave is a wave that when there's a return movement after the high price update or the low price update, the previous high price becomes the support and resistance and rebounds again to form the high price or the low price, depending on the direction that we're trading. All right. In this case, the high price. The S wave is formed from a pattern that repels at the previous high, all right, or the previous low if we're in a bearish market, and forms these waves. All right. Therefore, it becomes a wave that is likely to be formed when a bullish or bearish trend is emerging or continuing. So basically, these are continuation patterns. The 2-point bottom is called the preparatory composition run-up period. That's this right here, the 2-point bottom. That's called your preparatory composition run-up period of the rising market in Ichimoku. Okay. So it's the shape after the bottom of the inverted head and shoulders shape, basically, and represents a state where there's no fear of lower price for the time being. So basically almost your inverted head and shoulders pattern, but you only got your what side shoulder? This would be your head and your shoulder. All right. And that's what you would be looking at. But you basically, it'd be half of an inverted head and shoulders, or basically, like I told you, triangle pattern, inverted triangle. All right. So that's again your preparatory composition run up period. Let's move on. Let's talk about trading this thing. Any questions at this point? All right. Do you see the S wave formation? Does anyone see that S wave formation right now? If you see it, let me know. Cash, you should be seeing this. Okay, you said you see it. So where does it start? Does it start here? or farther back or forward? Farther forward or farther backward? I say it starts farther backward. That's where I see it starting. Because now, remember how now you don't really see the 2-point move here, but you do see basically like a triangle pattern. See that? Now don't look for this all the time. I'm going to show you what I look for. But that's what you see in this pattern here. You see this basically a nice triangle pattern. All right, and then you could see the market move higher. Now that's not what I look for. I'm going to explain it a little bit deeper. Now you should see it. Now you should be able to see that whole pattern. You could see where we started here, made the high, fell down, getting into that preparatory stage, and then we broke this level. We almost didn't, but we did. And when we broke that level, this level now, all that's happening is it comes to support. Now, let me tell you what. Inside of this whole big pattern, because this is a big pattern. I usually don't draw them this big. I just drew it big so you can see it real good here. Inside of this big pattern is a couple other same pattern. All right. Now let me show you. And I trade these smaller patterns. I don't trade the bigger pattern like this. This is the leg right here. This is the S wave right here. Came right back at this point, started at this point, dropped, preparatory preposition, move higher, and then drop back here. This is where I get into my trade. I had an inside day here, and then I can get into the trade, and boom, I catch the profit. In this case, it was a bigger pattern that I'm talking about, but there's more patterns inside of one pattern. But I wanted to be able to make sure you guys see this. So actually, there's like this pattern started here, moved up, but now we didn't come all the way back. All right, but this was the level. And then we moved higher. All right, broke out of this upper level and formed a new one. Broke out of that one, formed a new one here that we would have been looking for, but prices weren't able to break this level, which is the 2 level on Ichimoku, which is your 1, 2, and then you have your V wave. All right, so if you have a V wave, let me clear this. If you have a V wave, and actually this would be, if I'm talking even, let's just go with this right here. Let's say we were here and we got a V wave. If we can't break this upper level, then we're not going to get an N wave, which means we're not going to continue to the upside because we can't break this upper point. And what you're starting to see here is a change of direction. All right. That's what you see short term right here. Change of direction. But now when we get to this bigger pattern, we're looking for the bounce of this level. Well, let's see what happens. This is what I trade mostly. Everyone thinks I'm strictly Ichimoku, but I'm a trader. Wherever I can make the money, however I can make the money, that's how I make the money. What happens here? An inside day. Perfect. When I'm looking to trade the market, what did I tell you I'm looking for to trade? The way I know and understand the direction of the market is like this. The N waves that I told you about, following those patterns, and then also this, if I'm looking to trade. Always want level signal trigger. Always. But here's my level. See this market trading inside of this candle? Now really we broke below a little bit here. I have boxed this in. If it's going to break to the upside or the downside, it has to break out of that box. That's inside trading. I call it inside trading because we're trading inside of one candle. It happens throughout the whole market. And that's the way I look for the direction of the market. We're trading inside of one candle right here. And it drops to the downside. So what I was thinking would be wrong, right? Because it dropped a little lower. before gapping up. Now we're in a stock here. Again, you're trading inside of one candle right here, and it breaks out right here. That's how I know I'm able to get into the market. All right, and then the market retraces a little bit. Then what does it do? Basically trades inside of one candle right here. Gives you a nice inside day right here. Should be able to catch a trade at that point. All right, but then if you weren't sure again, it even trades inside right here. And you want to go in the direction of the market. It breaks out of there. You're able to catch the trade. These are support and resistance points. Inside days, it's stopping the market from moving lower. It's stopping the market from moving higher. We're talking about support and resistance. Anything that we talk about basically is going to be support and resistance. Any trader that's trading the market, more than half of the things they talk about is going to consist of support and resistance. Even traders that are trading these indicators, those indicators are basing off of support and resistance levels a lot of time. All right, so support and resistance is super major in anything that you do with trading. So that inside day occurs. A couple ways I can trade it. I can get my entry here. I can be aggressive and trade it at this point because I know now that basically I don't want to be lower than this point. If I get stopped, that's where my stop loss is going to be. So basically, I can enter the market here instead of here. Most traders are going to look for the entry at this point. Now, this is where you want to be entering the market. All right. And in order to do that, again, you have to drop to the lower time frame when you get to this level. And then what do? When the market gets down to this level, you have to drop to the lower time frame. And then you have to go to like the 1 hour, maybe 4 hour. And then you have to look for, here's what the market's doing to this point. So let's say I'm starting here and I'm going to go to here. So we're starting here. That's this. The market's basically doing this. Bap, 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 bap. Right? Breaking these bear fractals on a lower time frame. We're on the 1 hour time frame now. So now we get to this point. That's where we want to catch our trade. Now the market starts doing this. Broke a bull fractal on a lower time frame. Instead of me entering here, I'm on a lower time frame entering here maybe. And then the market continues to break that way and then goes like that. All right. That's all you're seeing here for this to move higher. And you're trading basically, now let me show you what you're looking at. You're basically trading Ichimoku, and I don't put Tengens and Kijins because I want to keep it clear here so you can see everything. All right. But you're also basing, you can see you've got support of the cloud. Now, yes, you did break through. All right, and you had a change here, and you probably have a TK crossover that's bearish, which is probably letting you believe that the market's going to the downside. Now, again, in order for the downside to change and be relevant, you have to break this high. I mean, for the upside to continue, because you're already starting to break these lows. So you need to start breaking these highs again. If you can't, you're going to continue to the downside. So now the move here, we suggest we get in the market. We need to see the market at least get up to this point. And then to continue even farther, it needs to break that level. And then we're probably pretty sure where the market's going. Or else it's going to create basically a double top up here and then drop more. All right, or form some kind of a pattern. What would it form? Maybe a P wave, or maybe it will form what? A Y wave at the top. Remember? So those are the things you start to look for up here. So we just talked about those things. Now, let's see what goes on with this. Again, your entry, again, I enter at this point or the lower level from the lower time frame. Stop loss below that point. Target 1-to-1. Can we hit 1-to-1? Well, if we don't hit 1-to-1, we probably at least can hit NT. And we probably hit NT for sure. I believe that would be around the NT level. 1-to-1 would be here. We didn't quite achieve it, but we did hit the 61.8, the 61.8 extension level right there, as you could see. All right, which also close to the NT level. We didn't quite hit the 1-to-1 right there. Now, let's move on. I'm just about done here, guys. Do you see the S-wave pattern here? Does anyone see the S-wave pattern right here? The big one, the big S-wave. Does anyone see it? I'm waiting to see if anyone sees it. So far, nobody can say they see it, so let me show it. Now can you see it? I gave you more clue, so you should be able to see it now. Can you see it? I don't believe anyone can see it. Oh, Brigitte, right? I don't know how to say your name. It's so nice looking, but I don't know how to say it. But you said yes, you can see it. Okay, let's see if you can see what I see. There. That's the wave. That's the S wave. If this was what you saw, then you are correct. Now we can enter at the resistance level. The Kumo breakout is in effect, but the chart pattern appears to be hindering the upside movement. All right. The Kumo breakout is in effect, but this chart pattern is hindering this breakout move. All right. Louise did not see the breakout. The S wave. Didn't know that was an S wave, says Cash. Well, that's the S wave, because look at that. Now it looks weird because the drop, this is a stock we're looking at, and you got a gap, big giant gap. All right. Remember we talked about them breakaway gaps, breaking off of a pattern. Then the market dropped to the downside, pulled back up to this level. And now, what are we looking for? A lot of traders are going to trade the Kumo breakout, looking for the move to the upside. They haven't looked at the whole chart, all right, and the price action. Basically, the structure of the market. What kind of waves? Now, if you look at the small wave, you see N waves to the upside. But now, if you look at the overall market structure, the big pattern, we need to break this level to continue higher. But the break of Kumo would be a representation that we are going to move higher. We could move higher. That's how a lot of traders now would just look at it. But I do see the structure of the market before I think about anything else. The structure of the market, the N wave, the V wave, I wave. Basically the N wave. We don't need to be too deep with the N, I wave, V wave, but you still need to see those. The N wave, then the consolidation waves. So your N wave, you need to make sure you can see, because that's your direction. And then your consolidation wave is going to show you if the market has stopped making those N waves. There's still N waves within the consolidation, but at this point now you're seeing a Y wave, P wave, or S wave. That's what you would be looking for at the bottom or the top or in the middle to continue. So if we're looking to continue this downward move and we see an S wave, that's more important to me than this breakout. It is based basically off of I base it off of the fractal structure myself. Basically, the reason being is because you can see it much better. Now you could put the zigzag indicator on here, and it'll draw these for you. But I don't love the zigzag indicator. I try to have it on my chart before, but I don't know. I kind of like to do it myself. But that zigzag indicator does draw it out pretty well for you. You will see patterns a little better, and you will see the N waves, I waves, and different types of patterns much better. All right, so you could use that. All right, but if you get used to just spotting this stuff, then you see the market. But it's not cheating. Put that zigzag indicator on there and use that. But remember how we talk about the market and how you have support and resistance when you're trading inside of one candle. All right. So if you're inside that one candle for a while, that's support and resistance. Inside days are one candles, because it becomes inside from an inside day to an inside days. That's support and resistance. All right. So now you got that to let you know that the market may hold there or may break out there. So again, you can find inside days throughout the whole chart, and you want to trade them the direction of the trend. If they break the wrong way, then you know that's not what you're looking for. All right. So those are big signs with the market. So I do base the wave structure and any points based off of the fractal levels. All right, but again, you can even see these without the fractals, because you should basically know where the fractal levels are too, right? So let's see where our target would be here, and then let's get out of here. This is our one-to-one target. This is a measured move target, which would basically be saying this leg. So I'm going to draw it out what an N wave definitely means. There's a difference between an N wave and an N projection, all right? The N wave is this. We're looking for the N wave projection off of an N wave, and we would say that it would be down here. All right. Now 1-to-1 would be this level. Probably NT would be here. This would be N. And E would be lower, so E would be down here somewhere below. And your V would be near your N level. When we do price observation, you'll be looking for those. Let's see what we get with this market. How we get into the market also. So basically you hit this level already. You could make this into a zone, right? Because what I would do is this is the lower zone and this is the upper zone. And at this point I look for trading inside the zone. If I don't get trading inside the zone, I know I want to trade below this point. All right, because basically I boxed the market inside of this zone now with that low and this high, this low. And then I could go to the 4-hour time frame or the 1 hour minus what I'm talking about here. Instead of doing that, just go to the 4-hour or 1 hour and trade the first break of a bear fractal. Boom, enter the market and I'm good to go. All right, somebody told me on YouTube, I posted something about fractals. I posted a fractal video. Somebody told me on YouTube that fractals were lagging indicators. Fractals are lagging indicators if you don't know how to use them as leading indicators. When I already have this level marked as a fractal level of support and resistance, that's leading to me. It's lagging if you're trading these fractals and waiting for the fractal to develop. Once that fractal's developed, it is now leading because I'm looking for trades off of this fractal level. So it is now leading to me. How do we get on these fractals? Because fractals are support and resistance, but now we're really getting to the point of fractal trading. All right, so let's break this down. Let's get out of here. Let's see what this trade could do, would do, should do, might do. There it is. Break that level. You're in the trade with a sell stop there. Stop loss, I would put my stop loss a little bit above the zone in the middle. I don't want to see price come back at far anyway. All right. And then it gives us a good trade. You guys probably get out in here. And then it goes again. What did it just do? Not the S wave, but the N wave. It didn't create an S wave. It created an N wave here. That let you know the direction of the market. First of all, it created an I wave. All right, let's clear this up. I kind of watched to see what the market's doing because it created an I wave here. This was another leg of this big extension N wave. But then in the little picture, it created a V wave. See that V wave? And then that V wave should create a N wave. When you add another I wave, 3 I waves, create an N wave, and that's what you have there. Therefore, I know that if we break this level, we should be going lower. If we can't break this level, then we're probably going to be ranging or creating a P wave or a Y wave and then going that way or maybe this way. But that wave, that P wave or Y wave may tell me something, and it doesn't even have to be that. It could also be just a rectangle at this point, right? So this 2 point is very important. All right, so you have your wave and you created a V wave. You need to break this 2 point. This is your 1, 2, pulled back 3, shooting for 4 right here. When we talk about targets, that's always what we're talking about, shooting for 4, which could be an N target, an NT target, a E target, or a V target. And that's what we're talking about. Our 1-to-1 ratio would be this 4 also. But you need these 3 legs, 3 waves to create an N wave. And you kind of know what the market's going to do if it can't break that 2. If it can't break that 2, it could form a rectangle. It could form a P wave. Or else it could perform a Y wave. And then at that point, you may know what it's going to do. Sometime by the time you catch it or realize it, you've lost a couple trades. All right, but I think I'm pretty much done now. Right? I am done. So guys, if you enjoyed what you saw today and really want to learn more about this stuff and more things that we talk about and have these weekly sessions, sometime a couple times in a week, then visit my site, fx@oneglance.com, become a member. You'll have access to all this stuff. And for you guys that are with me, this is your Ichimoku trading support and resistance from your masterclass. And I hope you enjoyed it. All right. Anybody have any questions? Hey, Bob, man, thanks. I'm glad to see you in here. And I hope you start using this stuff. And happy Easter to you, too. Okay, so Mike Sims is telling me something about the Euro USD, but I can't really look at it because I'm not going to live charts today. I'm just going to break on out, but seeing if you guys have any other questions. You're grasping that S wave. Please do grasp that S wave because that's going to be major trading opportunities for you. And it's one of the first trades I look for. Then I look for the other trades. All right, but it's one of the first that I look for. Happy Easter to you guys. Hope you have a great one. And until next time, guys, have a great one. God bless. So long.